Hi, I'm Steve Van Metre and welcome to your weekly economic update. I want to kind of do a follow-up on today's report. The bond owners are going to have the last laugh. Now, what I find really interesting, if you ask most investors how the bond market works, they have no idea. They really don't understand. In fact, even many professional investors who I read their research and their reports on, they don't understand it either. And what I've come to find over the years is a very small number of professionals really understand how it works. And so the default reaction is, well, interest rates are falling, at least on the long end of the curve. Well, that's going to be bullish for stocks, right? Because if interest rates go down, then people can borrow money to buy more stocks. And that really does actually make some sense, except when you really analyze the situation, what you find out is people don't borrow money on a 5 or 10 or 30-year loan to buy stocks. I mean, and thank goodness they're not allowed to, because, well, that would be really ridiculous. So people that borrow money to buy stocks on margin borrow on what's called the short end of the curve at short-term interest rates. And when the Fed tightens monetary policy, it causes short-term interest rates to rise. And it puts a crimp or a squeeze on these margin borrowers because they can't access more credit. So they're kind of limited to what they've got. They become at the mercy of the market. So the first notion is that lower interest rates are bullish for stocks isn't actually true. But the other dynamic you see, and where people get this wrong, is when money comes into the market, it either goes to risk assets or defensive assets. So risk assets, we'll just say, are stocks. Defensive assets will be bonds, even though there's subcategories on both sides. We could break it down, but we don't need to. So when stocks are rising, of course, where's money going to go? It's going to go into risk assets. I mean, it's very logical during bull markets. But when markets start to go down, investors start shifting defensively and put money in bonds, and without as much fuel or propellant to cause stock prices to continue to shoot higher, well, it starts to pull some weight down on them. But that isn't really the most interesting part of all of this. See, in our market, which you don't see this quite as much in foreign markets as you do in the US market, is you can bet on about anything, and there's multiple ways you can do it. So you can be a pure speculative investor, you can sell things that you don't own, you can do all kinds of stuff to create leverage and either bet big, win big if you're in the right side of the trade, or you can just get completely slaughtered if you're on the wrong end of the trade. Now, as we know, investors have been completely convinced that interest rates, at least at say 10-year rates, are going to 4, 5, 6, maybe even higher for all sorts of reasons which aren't true. And if they actually read and understood how our monetary system works, looked at historical data, looked at current data, they would see that the opposite is actually going to happen. But what they've done, because they're so convicted about interest rates going higher, they didn't just sell the bonds they have. They speculated. And what they did is they went to securities dealers and they said, hey, securities dealer, I'd like to sell a bond that I don't own. The dealer says, great, I've got this whole inventory of bonds. What would you like to do? And so I'll sell that one. So they borrow the bond, go out on the open market and sell it. In that act of selling, especially when you have a large pool of speculators selling bonds, it puts downward pressure on bond prices and drives yield higher. So not only do they convicted that, hey, this can happen and yields are going to go up, I can help force it happen by getting everybody I know and every investor out there to sell their bonds by driving yields higher. And I'll force them into stocks, which I have borrowed money again, and I have borrowed money to buy stocks. So if I get them to sell their bonds and buy stocks, I'll make money on both sides of the trade. And that's pretty much what happened since 2016, is people bought stocks and shorted bonds. And so what's interesting is higher interest rates actually drive stock prices up, because when someone borrows money from a securities dealer, goes out on or borrows a bond from a security dealer, goes out on the market and sells it, what do they get? Well, they get dollars, right? Because someone's buying that bond from them is paying them in dollars. And so what are they going to do if they have those dollars? Again, they're going to come back to the age-old adage, risk or not risk assets. Well, if they're selling bonds, they're going to buy risk assets. That's just what they wouldn't turn around and buy more bonds. It really wouldn't make any sense. So all of a sudden you have higher interest rates fueling higher stock prices. So that's why when you chart interest rates and stock prices, you'll notice that they generally follow each other in that direction. So when stocks go up, I guess this way, when they go up, you see interest rates going up, and when interest rates go down, stock prices eventually follow. And what makes this really interesting, and we've talked about this over the last year and a half, is that there is currently the largest speculative short position on U.S. Treasury bonds in the history of the stock market. So you don't have just a few people betting against the bond market. You have the largest amount, not only number, but you have the largest dollar amount bet against the bond market. And they're doing it at a time when the Fed's tightening monetary policy, which causes short-term yields to go up, long-term yields to go down. And of course, again, they don't know this because they don't study monetary policy. So how does this create a huge opportunity, and how do bond owners get the last laugh? Well, this is how it's going to work. So as interest rates on the long end of the curve, 5, 10, 30-year bonds go down because the Fed is tightening, and of course, because banks are buying bonds, what happens is the profit margin of these short sellers, so they're looking at their accounts and saying, hey, interest rates are going down, here's where I bought, and here's the current price, and it's coming down, 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 down. At a certain point, it'll hit where they're either losing money or about to lose money, and they will want to exit that short bond position. So how do they exit it? Well, they owe the dealer a bond. So effectively, the short seller has to go out to the bond market, buy a bond, and give it to the dealer. And that act of buying a bond causes interest rates to go down. Now, you might say, well, but how is that going to bring stock prices down? Well, it's pretty simple. So let's say I want to get out of my short bond trade and I need to go buy a bond. Now, where am I going to get the money to do it? Well, the logical question is, well, you've got to have some cash in your brokerage account, Steve. Wouldn't you just use that? Well, I would if I had any. So the data says right now that investors have one of the smallest historical cash positions in history. I mean, we're talking not a whole lot. So yeah, they could absorb some of it, but when you have a regular speculative position against the Treasury market, you've got a lot of people that are going to need cash to buy these bonds. So what happens when they run out of cash to buy bonds? Where are they going to have to go to? They're going to have to go to their risk assets or the stock market and sell their equities to raise cash to buy bonds to cover their short position. So when you have a huge mountain of debt, so we have the hugest margin position of debt underneath the stock market, plus you have on the other side the largest short position in treasuries, well, you've got an interesting scenario, because if you own bonds right now, and you probably think, God, I wish I would have owned stocks instead. Trust me, you're going to get the last laugh, because what's going to happen is as the Fed continues to tighten, and we do know that they are tightening, and we can look at the data, we see they are tightening, they haven't stopped. At some point, they're going to squeeze these short sellers out to the point where they're going to be forced to sell, and they're going to have to go to the stock market to sell their stocks, to buy bonds, and drive yields down. So what's going to happen? Bond prices are going to go up, stock prices are going to go down, and at some point that's all going to stop, and the people who have bonds right now are going to make a bunch of money on the swing up. There's going to be a huge demand to buy those bonds. As stock prices go down, they're going to be able to sell some or all of them, whatever they want to do, and buy stocks cheap. And what makes this really interesting is if you go back in history, you see this happen in roughly from January 1930 to the middle of 1930, where there's a roughly 6-month period where stocks just exploded because you had this dynamic where people got flushed out of their positions. And I think that's coming. And when we look at the charts here in a little bit, you'll see that it is actually continuing to build. The content of this video is provided as educational information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity, and opinions expressed video or diamond do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Now, the other benefit isn't just the fact that the Fed's tightening, the banks are buying bonds in large numbers. The global economy is slowing down. We're starting to see in the auctions, large money managers are starting to buy bonds. There's starting to be a demand for this. So all of a sudden, there's just the squeeze is coming. And when it happens, it's going to be big, it's going to be fast. And I'm betting the Fed's going to back off, and that's going to be the catalyst for risk assets, and that'll be the great opportunity for those who have bonds to sell them and buy stocks. Because let's say you're sitting on stocks, right? and there's another 20% decline to them. You're not going to sell yet. You might sell some of them, those that you have to if you're trying to cover your short positions, but a lot of retail investors won't sell. They will just sit there and look at their statement and go like, oh man, I'm way upside down. What do I do? Well, they'll be told to stay. That you'll watch. The media will come out and say, oh, don't sell, don't sell, don't sell. Hang on, it's going to rebound. And it will, because all of a sudden, this dynamic where you have these people selling having to rebuy their bonds to cover their short positions, well, that will create a reverse dynamic where all of a sudden that will shoot stocks up. And the reason it'll shoot stocks up is because large holders of stocks, rather than selling them into a down market, which is not a good idea, they will hedge it. They will start shorting the market. They will buy volatility. They will do things to hedge their position. And when the dust starts to settle, they'll unwind those hedges, and that'll be a springboard for stocks. And again, that's exactly what happened in 1930. And I really think it's going to happen again. So let's switch back over to the charts, and let's take a walk down the charts and see what we find. Now, this is really interesting. The M2 money supply, we've been looking at how this was touching almost 5%, and all of a sudden, you'll notice they put up to 4.52, and you're like, well, how can it go up from 4.25, 4.52 if it was almost at 5 a week ago? Because they've heavily revised the data down following the government shutdown. So what we're looking at is kind of new data, and we see the trend there. So we see it's kind of risen here. We know much of this right in here came from people selling stocks and putting their money in cash. So this is not real money supply growth. It's temporary. But we can see that this probably should have said increased instead of decreased, 21 billion to 628, but it was up here and now it's been pulled back down. And what we're coming into in the data is we're starting coming to where the government shutdown is really we're going to start seeing that in the data. And in the meantime, we saw last week the 6-month and 3-month rate of change were rolling down. Now they're rolling up because the data was revised down. Looking at commercial industrial lending, we're starting to see a little rollover here on this. It dropped from roughly 11% to 10.6%. And that is against 1.09% a year ago. So we're talking a 10% growth rate on a super low growth, but it's starting to roll over. And I suspect that as we've seen forward earnings declining, that this is going to roll over and start to head back down. And that should bring the US dollar with it and be a springboard for gold. Looking at consumer loans, credit card data, slight move up. It's not a very strong move compared to what we've seen somewhat in the past. The trend is still down, and as consumers borrow less, that's just bad news for the economy. More data that shows there's no Fed bailout of the markets here is they dropped 13 billion. This would be last week. This week's data is always behind a week. So they got 28 billion to go. We know they did unwind this week because it was in the auction data. And so here you can see they are on a fast approach to get under 4 trillion, possibly by they should be there roughly at the end of the month. If not, they will get there in March. So no bailout from the Fed. Bank deposit growth is up slightly, 2.25%. This is negligible. Consumers are just not prepared for a recession at all. This is just so dangerous as the global economy is cooling. So this is kind of neat. The fellow, I actually don't even know his name because he posts on Twitter in a pseudonym. And so this is a Baltic Dry Index. It's a shipping index. We've looked at this recently, and we see that in yellow. And you can see the S&P 500 follows it fairly well. So saying the S&P 500 ought to head down to a cliff. Well, notably, another fellow that I actually pay for his research, but he posted this on Twitter because I don't have legal rights to take his newsletter data. He posted the Baltic Dry Index and said, wow, look at it's headed all the way back down to, it's January 27, a little below January 2017 levels. And then the guy who posted, the anonymous guy kind of posted an updated chart saying, here is a closer view of the Baltic Dry Index and the S&P 500. And you can see that it is looking to head much, much lower. And I think that's something we know is coming. And his prediction, the S&P is going to get down to, say, somewhere around 1900. And as you know, I kind of have been thinking that too. This latest surge in the market from December to roughly early this week, drove the S&P 500 price to sales ratio. So the price people want to pay for a share of stock is back near its historic record high. So for all the people who like to buy high, this is a great news because it validates they are actually buying high. What you really want to do is buy low, and that would be when the price to sales ratio is somewhere below 1.5. Ideally, if you can snag it down during 1, you've done better. Same with the anonymous guy. He talked about how rallies that have 19 out of 20 days up out of 30, and he went and back to 1929 and charted, the major years going forward. And he said, anytime you see this rally like we're seeing right now, it usually is an indication of a drop coming, especially when you're in a late cycle. So we can look at where are some late cycles that we're all familiar with. This would be the Great Depression. Up here you can see this occurred right before the dot-com bubble, and then it started occurring again right before the mortgage bubble, and now it's starting to percolate again. So this is where you see bear market rallies begin, when it cannot make new highs, and then all of a sudden it falls on its face. German factory orders post the biggest year-on-year drop. The European Union's largest exporter is now got major problems, and without the German economic machine running, what's bad news for the entire European Union. Says the whole thing's headed into a recession, and they have just marginally stopped their quantitative easing. This is all from the Fed tightening monetary policy. This is an interesting chart that popped up on Twitter, the Wyckoff price cycle, and got by the last name of Wyckoff, said there are phases in the market where there's accumulation phase where the big players buy, then there's markup where prices just shoot straight up, then there's distribution where the public is buying and the big players are selling, and then you get markdown where prices head down into the next accumulation phase. And he overlaid the S&P 500 going back to 2016, and he kind of was pointing out that, see this bear market rally here, that's going to be a down move followed by an up move. This is the move I'm looking for here, because I think it's going to come with the Fed backing off. I really think we're going to see the Fed say, okay, we'll drop interest rates, maybe we'll stop as much of the balance sheet unwind. I don't know what they're going to do, but it's going to come with some Fed capitulation. And it's odd that, or interesting to me at least, that this week the Fed came out and for instance defended their balance sheet unwind, as everyone thought they were going to stop it. So the fool is on the market for buying into the Fed doing something they have not said they're going to do. This is Treasury spread. Now, what Treasury spreads are is the gap between short and long-term bonds. Now, this is important because banks borrow at the short end of the curve. So they borrow and lend to consumers and businesses at the long end of the curve, and they make the money what's called on the spread. So when long-term interest rates and short-term interest rates start to get closer and closer, well, banks can't make that much money lending. So what do? They tighten lending standards. So you have someone with bad credit come in that maybe years ago could have gotten a loan, and now the banks are saying, you need some cosigner, some bigger down payment, better income. We don't want to touch this. And so as that happens, lending slows down, and in a debt-based monetary system, that means less money is being created, more money is being paid back, and that decreases the money supply, decreases economic activity, and creates recession. So what this chart is showing is when the Treasury spread rises, you can see it rises right into recessions every time. And currently we're right here, and that is consistent with where prior recessions have started to brew. And so we're headed kind of right into where this is going. And then our last chart is the S&P 500 earnings per share on a year-over-year basis versus the per valley, I don't know how you say that, global earnings per share lead by 12 months. And what this is saying, and we've seen some of these charts about forward guidance in companies that have just announced earnings. Now, it is worth noting that not all companies provide forward guidance. And out of the S&P 500, you might want to say 20% of them do, not many. But those that do are a proxy for what the rest aren't saying. And so they've been saying that, hey, earnings in the coming quarters are not going to look that good. And what this chart here says is, yeah, they're right. Earnings aren't going to look that good. In fact, it tells us that earnings are going to head lower And you can see, as looking back to 2007 and 8, well, when earnings head lower, and that we already know the stock prices aren't on here, but that tells us what's going to happen. We see the same thing in the late 90s. So we know that forward earnings per share guidance is headed lower, and that will bring stock prices with it. So that's the end of that. So let's close out of that real quick. Oh, we have to go look at what the banks are up to in the Treasury market. This is kind of interesting as we kind of zip over to the charts, because I would have predicted beginning of this week that banks were buying a lot of bonds. In fact, I may have actually said it, but actually they shed a little bit, which is interesting because what it tells you is money managers and investors are starting to buy bonds. And when they start to do that, that means they're getting nervous about the stock market as well. So let's take a look at the bond market here. From the bank's perspective, we have Treasury agency securities. They dropped, looks like about $8 billion. Their mortgage-backed securities held pretty much even, and they shed looks like $9 billion of non-mortgage backed securities. So they dropped a little bit. And what is interesting to me is when we go and look at the chart on this, and let me get over to the charts, is here's 10-year Treasury yield. So if we go back, so the banks have been shedding treasuries the last 2 weeks. And so they shed them right in here, and it caused this little rally. But they also were shedding them in here. So they started dropping a little here and a little here, but the market was buying bonds. So I'm kind of curious when we get next week's data, if it validates that this drop here was due to the banks or not, because at this point, we're kind of back at this really key Maginot line of treasuries where when we get back below 2.6%, this is a 10-year Treasury yield, we've got a quick move now down to 2.5. The short sellers defended this last time, but they did a weak job defending here, and they've done virtually nothing today. They didn't really defend this hardly at all. So it tells us the short sellers are running out of ammunition or conviction to do this. And if we zoom this back out, we can see every time it breaks below here, it's a very quick move down. In fact, it generally gets down over to roughly 2.3, but I'll hold at 2.5 for the moment and think they'll come back in. But the reality is 2.3 is the next major destination. And if that pulls against all of these people that were short, then you're back all the way to your pre-election lows. And by that point, you're yanking all the short sellers, and you're just creating a roll where it could drive Treasury yields all the way back down to their all-time lows. This is very possible due to the massive amount of speculative short interest on these positions. So let's go look at the broad market, and then we'll roll through some things to see kind of how everything looks. And so the S&P 500 got up to its technical resistance level just under 2735, and it spent 2 days there and got rejected. It closed just above its 100-day moving average in blue, and then right below it today, it started out below, and just imagine literally the final minute of the day. I mean, you can see right here is set to close below, and then somehow these computer algorithms shot this thing straight up, and it closed just over its 100-day moving average, because there are people that follow the moving averages very closely, and when it fails it, they will end up selling. But the question is this going to validate by dropping down here to say 2600, catching against its 50-day moving average and bounce? Well, I don't think so, and I'll show you why if we compare this to Treasury yields. So here's the 10-year Treasury yields, and you can see as Treasury yields are confirming down here that roughly the market, the S&P 500, needs to be at least down to 2,500, if not lower. So the Treasury market is telling the stock market, hey, you're going the wrong way. And the stock market's trying to say, hey, we're going to short you higher and bring you back up. But when we just looked at the Treasury chart, you didn't see that. I mean, we can zoom into today. You don't see heavy shorting like you see right here. You see absolutely almost no response. So that is telling us right now that the S&P 500 is going to make a retest of its December lows. The only question is, will it create a big squeeze in the bond market and that causes a greater unwind, bringing the S&P 500 somewhere down into this range? It very, very well can, and do not be surprised if that happens. All right, so let's keep going. How did we know that this moved? This is the new Volatility Etf. And for those of you who've never watched this before, don't trade this. Absolutely do not trade this. If you're going to read the entire page of every word in the prospectus, especially notice the part where it says you will lose all your money if you put your money in this. So don't do it. So volatility came down, and I thought it was going to hold up right in here. It didn't. It almost sprang loose up here, and short sellers came in and brought it right down to this support level, and then it bounced. Now, we have not been able to track what some of these big players are doing because the government shutdown is keeping some data from being reported, but I think they're going to get caught up later today. I'm hoping, and I'll get to see it this weekend. So there's a lot of people thinking, well, I'm not seeing a lot of trading volume in the S&Ps. Are they just shorting volatility again? And if they are, it's again setting up a squeeze as they get out of the bond trade. As they're forced out of their bond trades, they have to go raise cash. Well, they might have to unload their volatility shorts as well. And that just creates volatility going up, stock prices going down, bond prices going up, interest rates going down. It can create something very, very, very quickly. So what this tells us right now is volatility found support here. It should come up and retest right in this zone here. And this was at roughly 122. So you can see that the S&P ought to at least get down to 2,600. And if volatility springs and the bond market unwinds, you've got a quick test down to here, and again, potentially much, much lower. So let's take a look at the oil and gas producers, and you can see they are completely disagreeing with the S&P. They're headed lower. Today they closed below support, below the 50-day moving average. This is not a bullish sign. This is oil and gas producers are going to come down and make a potential double bottom. Again, this is one of my Fed capitulation trades that I think is going to create an awesome opportunity, because I actually think it's going to go below that bottom, the December low. I think if we get a big enough pull, it's going to create a tremendous opportunity, because if you look at what responds really quick, it's the oil and gas market. I mean, it really does. So I like what's going on here. I like that this is leading the market, and we can even look at that real quick if you want to see it. There it is. And you can see kind of following each other along. And here's the S&P 500 should be down here at 2,500. Just kind of what the bond market is, reiterating. So let's clean that off. Let's look at physical gold, and we'll go take a look at the miners. Where is physical gold? There it is. So let's zoom this out. So gold got this big rally off of here. The miners didn't really fully grasp this, but as I break the chart back further, when gold steps through a couple levels, so 1, 2, it comes back here. So we can go back way over here. See, it goes boom, 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 and comes back to this one, reconfirms, and then goes. Comes up here, comes back down, goes up, comes back down, goes up. It's always coming back down and reconfirming at least one of these levels. And it makes sense to me that it's got to confirm here. So this, because you got to think of it like a slingshot, right? So markets pull back and let go. And they pull back and let go. And if you've got enough big money behind this pullback and you let go, you can really spur a rally. But if it's a weak pullback, yeah, you can get prices rise, but it ends up falling back down, looking for more buyers. And I love this setup in gold because the trend is rising. We know the central banks are out of ammunition. The global economy is weakening. They're really in a dire situation, whether they want to publicly admit it. But you have gold that's been sold for over 5 years. And it's been held in this pattern at 1350-ish for a long time. I mean, we go back to middle of 2013, so we're over 5.5 years here. I guess we're more like 6 years out. Yeah, 6 years out here. And so what this tells us is all of a sudden, all these buyers down here, when they break the short sellers up at this line here, this thing's going to shoot. Now, what I did is I measured from here to here, and I put this line up here that says that gold ought to at least get here. Although I listened to an interview yesterday, a guy thought gold could go to 4,000 or 5,000 an ounce at some point, but he said there is going to be a pretty sizable move that's going to get everyone's attention. Well, this is where it ought to go. You measure from here to here, and then you just kind of flip this triangle up, and that tells you where gold is going to head when it springs out of this. So again, I want to get a nice confirming move here, and I think as we see the S&P come back down from its little rally here, it's going to tell us if these buyers in gold are real, or if this is all speculative. If it's speculative, it's going to pull way back below and not give us anything confirming. But if it hits those major moving averages or a support zone, yeah, now we've got something we can buy in on and know that our downside risk is pretty low. It doesn't mean we're infallible, it just means it's pretty low. And I still think it's got a quick move down to here. And this is where I'd love to see it confirm against this 200-day, 100-day moving average. That would be really sweet. And let's look at the weekly moving averages, not really giving us any major signals there. So that doesn't really help. So let's go look at the gold miners. Here they are. So they kind of sprung up here. And again, I think this is all speculative move because there's not a lot of volume, not a lot of buyers. So my guess is these are people who are bought using options. And again, I would expect this to come back down. I'd like to see it get right in here in this $20 range, confirm the 100-day moving average, which we've looked at. This tracks pretty nicely. And bingo, you've got it. And silver is kind of what I'm using as my baseline to track this, because silver's got over its resistance zone here, and then it kind of been pushing back down. It's trying to find support on its downward trending 200-day moving average. I doubt it's going to find it, but it's got two rising 50 in green, 100 in blue moving averages and support right here. So could we get a move down here that validates what gold needs to do? I believe so. Let's take a look at the bond market. This is really cool. Whoops, that's not what I wanted. Let's go back a 2-year chart here again. So 7 to 10-year Treasury ETF is back over its resistance zone for the third time and setting up for a pretty quick move up to here. But this is its major resistance zone way up here. Where yields are at 2.3, this is at 2.5. So at some point, we ought to start seeing this continuing to rise and put the squeeze on the short sellers. The long bond is trying to get into its resistance zone for the second time, again, putting it upward pressure on it as the moving averages rise. So look at this, the 50 days rising nicely. It's providing some downward support for it. We look at the 7 to 10 year, the 50 days rising. So could this go sideways for another week or so, a week, maybe two, hit the 50-day? Could, but with the banks still holding such a large position, this thing's got nothing but potential to just keep rising. And that's a really cool trend that will bring those stock sellers out. Now this chart here, we haven't looked at this in a while. This is WPP. This is the world's largest advertising corporation. And what's neat about them is when you understand that companies have to advertise to get clients, and when companies stop advertising or cut their advertising budgets, WPP stock goes down, and it tends to lead the market on the way up and on the way down. So you can see the S&P 500 pretty much followed it up and is hanging up here, whereas WPP is headed lower, which suggests that the S&P 500 1400. Wow, that would shock a lot of people. If we zoom out even further, now going back 20 years, you can see how WPP again leads the market up, leads it down, and the S&P follows it very nicely. But again, this suggests the S&P ought to be way down at 1400, and that is crazy because if we look closer at WPP, let's get rid of this. It tried to rally a little bit and it's not. So this is telling us that from a technical perspective, we have to zoom way out, really far out apparently. Let's zoom. That its support is not strong. I mean, if it keeps falling, it's going to break through what little support it has going back to 2011, and that means it's going to drag the rest of the market with it. Last thing I want to look at today is ag commodities, which I managed to be completely impressed by. You have 1, 2, 3, 4, somewhat 5, almost 6, 7 bottoms all at the same level. And I drew this line here so you could see it, but let's remove it. And this is weird because bottoms are formed when sellers realize where the buyers are at. Now, it should be very clear where the buyers are at. They're all right here, and they've been consistently here. I'm going to expect that Monday or Tuesday, this is going to reverse and head higher because the buyers have been very clearly under here. You also cannot short ag commodities to zero because people and animals, last time I checked, still need to eat. And what's been interesting is there's been no reports from the government on crop conditions because of the government shutdown. And I believe Monday, they're supposed to come back out with a report maybe the following week. I'm not sure. I just heard that it's coming, and it could be a big surprise. And you think about it, there's this massive freeze that went through the Northwest and the growing region. And all that tells you is there's potential for a lot of damage. And soybeans, which everyone's focused on, they don't last forever. You cannot, store soybeans perpetually. They rot. They just go bad. So if someone commented like, man, if that crop report does not give, the short sellers the news they want, this thing's going to unwind pretty quick. So just looking back at the chart, we can see that this thing at least ought to get back up at the top end of this trading range at some point. Once it gets through here, it's got nothing but upside. But there's been a lot of buyers over the last 6 months just continuing to accumulate and accumulate. And when buyers at some point buy up all of the demand, then the short squeeze is on, and this thing has got nothing but a rock engine just sitting under there waiting to be lit. So that's our update for the week. I'm hoping to have the hedge fund data, so we'll have at least something cool to talk about on Monday. I know I skipped this week because there just was nothing, but now that a lot of this data is starting to percolate back out as people are back to work, and that'll be interesting. And the next week we're on tap for a potential second government shutdown, so that'll be interesting. And then we heard today that we're not any closer to a trade deal, and President Trump and President Xi are not meeting on March 1st, and that was the deadline. So it'll be interesting to see if the Trump administration punts and just leaves things alone, or if they decide to further tighten it. But there is a delegation, I believe, headed to China between now and then, and a lot of weight is being pushed on the outcome of that meeting. So there's still risk to the downside here until the Fed stops tightening. But I think there's going to be a really big opportunity, and I have a feeling it's coming like in the next 30 to maybe 45 days. I feel it. I just feel like this big unwind in the bond market's coming soon. So I'm Steve Van Metre. If you have any questions, give me a call, send me an email. I'm here for you. Bye now.